The best buying opportunities in the stock market right now, the last one's gonna be very special because it's not only a growth company that I believe could do amazingly well over the long term, but I also believe it has a decent chance of outperforming the market in the short term. Meaning, if we do have a lot of uncertainty, if the market's going down, if everything is just weak, this stock has a very high likelihood of being positive while the S&P 500 and the Nasdaq are negative. I'm going to talk about all that stuff today, and I really hope you enjoy it as always. But before I get started, I just want to mention that the biggest mistake most investors make in a market pullback is they go and they buy all the cheap stocks. So whatever is cheap, whatever is turnarounds or whatever they are, this is what they go buy. But normally, from my experience, the best kind of stocks to buy in a pullback are stocks that are high quality companies, amazing companies that trade at a discount. You don't always find those stocks at a discount, but you could always find a gold miner or a construction company trading at a discount in any kind of market. So that's how I think about that stuff. And maybe later on, I could do another video of stocks that I believe could outperform in the current macro environment, which is a little bit weak. We could go into a recession, and I believe there's a lot of stocks that could outperform. But I'm gonna leave it for another video. The first one, and I'm not gonna spend too much time, those are 4 stocks. I'm gonna do a very quick overview, so a few minutes on each one. The first one is Amazon. Amazon, I did buy the dip again, about to the 205 dip. Now it's down 10.7% over the last month. Insane for the company. People were loving it just last month. Now they don't like it anymore. Why? Because the market's going down, or because we're going into a recession. And a lot of you guys know how Amazon makes money, not just with Amazon online. They have fresh food like Whole Food and all these kind of things. The advertising business is growing 18%, huge. Then they have the subscription, Audible, and all that kind of stuff. Prime, a lot of Prime members. They have Amazon Web Services, the largest cloud provider in the world, and it's still growing around 19% year on year. So that's pretty amazing stuff. And you're getting Amazon. And you're not only getting Amazon, but you're getting it at a discount. The company right now is trading at 19 times price to operating cash flow. And operating cash flow is the best measure of Amazon's profitability, as most of their CapEx you could say it could somewhat be pulled back anytime. But I did talk about this, that the company does reinvest in itself a lot, and that's why the PE ratio looks a little bit inflated. But it's trading at 19 times, only 19 times price to operating cash flow. This is well below the mean, and the operating cash flow is expected to keep growing around 20% for many years to come. It grew 81% in 23, it grew 36% last year in 2024. This year is expected to grow 23%, next year 22%, and in my opinion, it's going to be 20% for at least the next 4 to 5 years. So if it's growing if it's growing cash from operations 20%, and you're paying 19 times operating cash flow, you're buying Amazon below 1 time price to operating cash flow growth. That doesn't happen very often. And Amazon is giving you this opportunity right now, and they could easily grow to 20%. The company spends a lot of money, as I talked about, on research and development. They reinvest in itself a lot. So out of $300 billion in gross profits, they spend $88 billion in research and development, as the company is still focused on growth. But once Amazon someday reaches maturity, they decide to focus on profitability, doing buybacks and doing dividends, then they can pull back on a lot of those expenses, and the stock's gonna look dirt cheap. So that's how I look at it. The stock is cheap. If you're buying it below 1 time price to operating cash flow growth, and at 20% free cash flow, operating cash flow growth, I would expect at least a 20% annual return on Amazon from here with the growth of the operating cash flow. Worst case, I would say 15-17% kind of annual return on Amazon. But nonetheless, this is an amazing return on an amazing wide mode, safe stock, and you don't get those opportunities very often. The second one is Alphabet. Alphabet is down 15.4% on the month. Again, I can't believe that. Why? I mean, this is crazy. And a lot of you guys know how Alphabet makes money, not just with Google. They have YouTube, they have Google Cloud, which is still growing 30% year on year, massive growth for Google Cloud. But you also have the autonomous vehicles with Waymo. And as you can see on the green line, Waymo is taking market share from Lyft. and is disrupting the market, and they have commercialized those vehicles, and you get exposure to that. You also get exposure to quantum computing, where Google is a leader in quantum computing, and if they ever decide to split those businesses apart, like if Waymo was a separate stock, or if quantum was a separate stock, I talked about it. Even if you take half the search engine value off, you could check it out here in the video, you're still getting more than a double over the next 5 years. So the stock is very, very cheap. And it's now even cheaper. It's trading at 18.9 times earnings. This is insane. And 18.9 times earnings, and it's growing earnings 11% this year, expected to grow 14% in 2026, 16% in 2027, 60%, 15%. So I would say 13 to 14% on average. So if you get 30% earnings per share growth, you're buying it well below the mean. The mean is 23 times. You're buying it around 18.9 times. This is another stock I see at least 15, 16% kind of annual return with a safe company like Google, with an amazing balance sheet of 95 billion of cash and only $10 billion in long-term debt. So Google, to me, or Alphabet I should say, is another best buying opportunity in the market. The best one is Amazon so far. The second best is Alphabet. The third best, in my opinion, is a stock called ASML. This is another one I talked about. It's down 28% over the last year, and the company is buying back a lot of stock like never before, and they're taking advantage of those very cheap prices. They believe the stock is cheap, and if you want to learn more about the company, I did recommend people to watch this video titled "Why the World Relies on for ASML on machines that print chips," or something like that. And it's a very interesting machine and video where they show you what ASML is and what they do and all that stuff. But to sum it up, if you're bullish on smartphones, if you're bullish on computing, if you're bullish on robotics, if you're bullish on semiconductors, if you're bullish on data centers, if you're bullish on autonomous vehicles, if you're bullish on all these kind of things, and you want to bet on semiconductors, you want to bet on technology, you want to bet on the future, but you don't want to bother picking winners. You don't want to bother picking NVIDIA or AMD or AFGO or some kind of other stock. You just want exposure with one simple stock. This stock is the ASML. They have those lithography machines. They are needed to encrypt those chips. They have over a 92% market share, and the competition needs 10 to 15 years worth of capex to even be able to develop those machines. I talked about it more in depth in this video. So this is one stock that gives you exposure to everything all together, and it's still down 28% year on year. And this stock has been an amazing performer. And again, such drawdowns with the stock are normal, and then the stock goes back up, and it's presenting a decent opportunity here. The biggest risk with the company is 27% of their business is to China. So they export a lot of the stuff to China. And, the US government has been trying to put restrictions on the Netherlands for them to not, ship those kind of chips and machines to China. And that's some serious stuff, and it has been going on for a while. And the company expects their business in China to go from 47% it was, now it's 27%. They expect it to go to 20%. And it's all baked in guidance. So I don't believe it's as bad as everyone else believes. And I think the company will just be fine. That's just my opinion. And I talked about this more in another video. But now the stock is trading at 28 times earnings. The mean is around 30 times. It's now trading around 28 times. As you could look at this line, 28 times earnings has historically been an amazing time or an amazing price to be buying ASML stock at. The stock is still growing in earnings per share 23%. They're expected to keep growing 20 to 23% for the next 3, 4, 5 years. So this is another one where I do a simple overview. And I see the stock trading below its mean PE ratio. Even though now we have AI and we have many different tailwinds we did not have before. We have the United States. They want to expand in semiconductors and they want to bring it back to the United States. If they want to open those fabs, they need the ASML machines. They just need them. So there's so many tailwinds for the company, and it's trading below its mean PE ratio. which to me is very, very interesting. And the way I look at it is if I don't get a further multiple contraction from here, if the multiple remains the same, and if the company keeps growing earnings per share 20 to 22%, I'm likely going to get a 20% annual return from here with a company like ASML. And I just want to remind you that the long-term return of the S&P is 8%. And with those stocks, Amazon, I told you could get 20%. Google, I told you could get 14, 15%. ASML, you could potentially get 20%. And such things, they don't happen very often. And that's why I decided to include the ASML. Now, the last one, which might surprise a lot of you, and this is the stock that I believe has a decent chance of holding up a little bit better in what we could have a potential weaker environment, market pullback, whatever you want to call it. It has the potential to hold up better. And this stock is SoFi. SoFi so far is only that, and it's still up actually, 2.5% on the year. Many growth stocks got decimated, they're down 20, 30, 40, 50%. But SoFi is still up 2.5% on the year, and the company is doing well. Now, if you look at financials, they tend to do well in this specific environment of not much growth, potential recession, all these kind of fears. Financials, they're up 8% on the year, and SoFi is a bank. That's just the way it is. It's a financial stock, and I believe SoFi will ultimately follow the path of the financials kind of ETF. But the best part about SoFi, and I'm going to try to keep it short, is the company is moving away from interest-based revenues to fee-based revenues. And as you can see here, the fee-based revenues were only 25%. Now they are 47%, and they're expanding them. Now, the reason why that's important is the fee-based revenues allows them to benefit from originating the loan, and they don't have to hold the loan on their balance sheets. So they're benefiting without taking on any risk. The other companies, they hold the loans. SoFi has the servicing rights. So if someone wants to pay the loan, they have to pay it through SoFi. SoFi collects a fee on that. And they also collect a fee for originating the loan and hooking up the buyer to the seller. So they are more of a middleman than just a bank that collects interest on that stuff, even though it's still 53% of the revenues. And ultimately, as they move more towards a fee-based revenue, more towards a tech platform than just a bank, the stock will ultimately get a multiple expansion. And I talked about it a little bit more in other videos. Now, the company has, I'm sure that's all I'm going to say. The company has a history of beating guidance. They always set a low bar and they beat the estimates. So in 2024, their guidance was 7 cents. They did 15 cents. I mean, that's no one does that. I mean, no one does that. And the stock right now sold off because the CEO said they're gonna do 25 cents in 2025. Don't be surprised if they do 30, 32 cents. And that could give the stock relative strength. If the market is going down, the stock is double beating, triple beating, it could help it hold up a little bit better. But SoFi, the CEO, has a good record and you have to trust his estimates. And he's guiding 55 to 80 cents per share by 2026. Now, if you use the mid-range of 65 cents, and by the way, after 2026, they're still expecting 20 to 25% annual earnings per share growth. This is beyond 2026. What an amazing company. Now, if you do get to 60 cents in potential earnings per share by 2026, which is a year and a half from now, and then we time it by 40 times earnings, I don't believe 40 times earnings is expensive if the company is growing 20, 25 times earnings with higher margins. I don't believe 40p is expensive. So if we time it by 40 times earnings, in this case, I would get around $24 per share. The stock right now is still trading around $14 per share. This is around 71% on the upside over the next year and a half, with the way SoFi is as a financial or as a bank. So I see the stock as an opportunity in the short term. It could hold up a little bit better, but it's also a decent long-term investment that I talked about in my other videos. And that was just a very fast and quick overview of the 4, in my opinion, are the best buying opportunities in the market. If you want to learn more about what I do, what I'm buying, what I'm selling, all these kind of things, I'm still up 8% on the year. So NASDAQ is down 2.5%. Buy tech stocks and hold forever. It's not going to work anymore, at least not for the next 2 to 3 years. You need a little bit more strategies. If you're interested more in that stuff, you could check out the link here and join my group if you're interested. But thank you very much for watching. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.